You're scrolling through social media and you see someone posting about forcing interest rates down to just 1%. Your eyes light up because you're imagining a $200,000 mortgage payment suddenly dropping by hundreds of dollars every single month. Today, I'll explain the 1% interest rate fantasy like you're 5 years old. And by the end, you'll understand why it sounds amazing on paper, what chaos it would actually create, and why it's almost impossible to make happen in the real world. Most people think interest rates are just numbers the government picks based on vibes. But rates are actually signals. They tell you how expensive it is to borrow money right now. When rates are low, borrowing is cheap, so people buy houses, start businesses, and spend aggressively. When rates are high, borrowing gets expensive, so people save more and spend less. The Federal Reserve moves rates up and down to keep the economy balanced. Too hot, and you get runaway inflation. Too cold, and you get mass unemployment. Rates are the thermostat. And right now, that thermostat is set way higher than people want. So the idea floating around online is simple. Force rates down to 1%, lock them there, make mortgages dirt cheap, make business loans practically free. Let the government refinance its $36 trillion debt at basement prices and save trillions in interest payments every year. On the surface, this sounds like a miracle cure for everyone's financial stress. Your mortgage gets cheaper, your car loan drops, your credit card rate falls. Businesses borrow billions to expand and hire. Housing demand explodes because suddenly everyone can afford to buy. Stocks and crypto rocket upward because cheap money floods into risky assets looking for returns. It would feel like someone just handed the entire country a raise. But here's the catch. Cheap money doesn't create more stuff. It just creates more demand for the same amount of stuff. Imagine everyone in your town suddenly has double the cash, and they all rush to the same grocery store. The store doesn't magically have more food. Prices just go up because everyone's bidding against each other. That's inflation. Forcing rates to 1% would pour gasoline on that fire. We just spent 3 years fighting to get inflation back under control. Dropping rates to 1% would risk bringing it roaring back almost immediately. Now here's what nobody talks about. Savers would get destroyed. If you're retired and living off bonds or savings accounts, a 1% rate means your money earns almost nothing. Right now, you can get 4 to 5% on a safe treasury bond or high-yield savings account. Drop rates to 1% and that income vanishes. Retirees who depend on interest to pay bills would suddenly be scrambling. Pension funds that need steady returns to pay out benefits would struggle. Insurance companies that rely on bond income to stay solvent would face serious pressure. Even if you're young, your parents or grandparents might be the ones getting crushed by this policy. Then there's the bubble risk. When money is that cheap, people stop caring about value. They just borrow and speculate. Housing prices would surge because everyone can suddenly afford bigger mortgages. Stocks would climb, not because companies are doing better, but because investors have nowhere else to park cheap, borrowed cash. Crypto would pump for the same reason. And all of that creates bubbles. Bubbles always pop. When they do, regular folks who bought in late thinking prices would keep rising forever get crushed. You saw this in 2008 with housing. You saw it in 2022 when the Fed raised rates and everything crashed. Forcing rates to 1% sets up the same cycle all over again. But wait, there's more. The Federal Reserve is supposed to be independent. Congress created the Fed but doesn't control it day to day. That independence exists for a reason. It keeps politicians from manipulating rates to win elections or juice the economy short-term at the expense of long-term stability. If Congress forced the Fed to drop rates to 1%, it would shatter that independence. And the rest of the world is watching. The US dollar is the global reserve currency because people trust it. They trust that America won't play reckless games with monetary policy. Break that trust, and the dollar weakens. Foreign investors dump U.S. bonds. Borrowing costs for the government skyrocket even if the Fed sets rates low, because nobody wants to lend to a country that's lost credibility. So could this actually happen? Not likely. Congress would need to pass a law overriding Fed independence, which would face massive legal and political battles. The Fed could voluntarily drop rates, but only if the economy justified it, like during a severe recession. Right now, unemployment is low and growth is steady. There's no economic reason to slash rates to 1%. Doing it anyway would be reckless, and the Fed knows it. Even if a president pressured the Fed publicly, the Fed chair serves a fixed term and can't be easily fired. The system is designed to resist exactly this kind of political interference. Here's where it gets even more complicated. Even if you somehow forced rates to 1%, the market would fight back. Bond investors would demand higher returns to compensate for inflation risk. Mortgage rates wouldn't actually drop to 1% because lenders add their own margins on top of the Fed's rate. The Fed controls short-term rates, but long-term rates like mortgages are set by the market. If the market thinks 1% is insane and inflation is coming, they'll price in higher rates no matter what the Fed says. You can't force the entire global financial system to ignore reality. Markets have their own logic, and that logic always wins eventually. Here's why this matters to your daily life. Interest rates affect everything. Your mortgage payment, your car loan, your credit card balance, whether your employer can afford to give you a raise, whether your retirement account grows or shrinks, whether homes in your neighborhood become affordable or out of reach. Rates even affect grocery prices because higher borrowing costs get passed down to consumers. The fantasy of 1% rates is tempting because everyone wants cheaper money. But cheap money only works if it's matched by real economic conditions. Force it artificially, and you're just delaying pain while making the eventual crash worse. And here's what's really going on. The conversation around 1% rates reveals something important. People are frustrated. They're tired of high mortgage rates after years of rock-bottom borrowing costs. They're angry that the Fed raised rates so fast and made everything more expensive. That frustration is real and valid. But the solution isn't to break the system. It's to understand why rates went up in the first place. The Fed raised rates because inflation was out of control. Prices were rising faster than wages. Keeping rates low during that environment would have made it worse, not better. Rates are high now because the economy was too hot. Forcing them back down before the economy cools would just restart the whole cycle. So to recap, forcing rates to 1% would create a short-term boom, followed by inflation, bubbles, and financial instability. Savers and retirees would lose income. The dollar could weaken. Global confidence in U.S. markets could crack. Congress can't easily override the Fed without destroying its independence. Even if they tried, the market would resist, and long-term rates wouldn't actually drop that low. The Fed won't voluntarily slash rates unless the economy collapses. And even if all of this somehow happened, the long-term damage would outweigh any short-term benefits. So here's the real question. Would you take artificially cheap money that feels great for 6 months and then explodes into chaos? Or would you rather have a stable system that might hurt now but keeps the economy functioning long-term? Drop your answer in the comments, because I want to know where you stand on this. The truth is, there's no free lunch in economics. Every policy that sounds too good to be true usually comes with hidden costs that show up later. The people promising 1% rates aren't lying about the benefits, they're just ignoring the consequences. And those consequences always land on regular people, not the politicians making the promises.